Thank you for joining us. The following presentation is from a webinar titled Construction Industry Technical Update, originally produced on August 15th, 2013. The presenters are Michael Hoffner, David Blain, and Lisa White, all with McKonly Asbury. Enjoy the presentation, and be sure to visit us online at www.macpas.com for information about our future events and upcoming webinars.
Good afternoon and welcome to the McKonly Asbury Construction Industry Technical Update. My name is David Blain. I'm a principal with the firm. Along with me today is Lisa White, Senior Tax Manager, and Mike Hoffner, Partner in our Audit and Accounting practice. Okay, just to get started here, let's talk about the presenters real quick, our favorite part of the presentation. My name is, again, David Blain. I'm a principal with McKonly Asbury. Have been with the firm for about 9 years. My focus with the firm is specifically on our construction and manufacturing practices, working on a number of different clients from the audit and accounting side to looking at them from a business perspective, CFO roles, controller activities, and helping them with planning, forecasting, and budgeting.
Thanks, Dave. As Dave mentioned, my name is Lisa White. I am a senior manager with the tax practice with McKonly Asbury, and my focus is on real estate and construction.
Thanks, Dave and Lisa. Very much look forward to today's presentation with both of you. As David said, I am a partner in our assurance and advisory practice. My primary areas of responsibility are relative to quality control of the firm's audit practice, as well as a focus on construction and manufacturing, as well as a few other industries. I think as we go through today, we have a lot of ground to cover, and so we'll just go ahead and get started, and I'll turn it back over to David.
Okay, thanks, Mike. My part today will be to talk a little bit about where we're at in the construction industry, the trends that we're seeing in the construction industry, and where the industry looks like it's going in the next couple months into 2014 and into 2015. There's a number of good, solid key indicators out there that tell us a little bit about where we're going into the construction market. What I want to do today is focus on a couple of them that are out there that are easily accessible. Their information's updated on a regular basis, and they provide a really good understanding about where the industry is going. Those key indicators I'm going to talk about today are: the number one is the Confidex quarterly reading, the Architectural Billing Index, which is done by AIA, the FMI Construction Outlook Report, the ENR Construction Industry Confidence Index, and then finally the Associated Builders and Contractors ABC Backlog Indicator. Now that we're coming out of the dark days of the Great Recession, we like to call it, obviously we're all aware in the construction market that the Great Recession had a major impact to the construction industry. But what we're seeing from a very, very high level, and if you looking at a lot of these economic indicators across the board, is that the construction industry appears to be finally turning the corner and coming out of those dark days. We may not be where we were back in the mid-2000s, 2005 and 2006 timeframe, but clearly the indicators are showing positive signs across the board. So when you look at it, before we get into the details of all these different construction indices, the macro analysis of it all shows again that we're coming out of this recession. Although some of the indicators do show some varying results, but overall the mood and the climate of the construction industry appears to be moving in a positive direction. The results do appear to vary by industry and region of the country, and we're going to see that as we go through some of these economic indicators. But overall, the long-term outlook for the industry continues to show slow and steady growth through 2014 and into 2015. So let's first talk about the Confidence quarterly reading. What I want to do here is just kind of give you a little bit of background on what this quarterly reading is. So the Confidence is a leading economic indicator of the health of the commercial construction market in the United States. The Confidence reading is done by CFMA, and that's in its proprietary Confidence Index survey of CFOs in the commercial construction sector. And what they do here is what they'll do is they'll survey a random number of CFMA general members who have the title of CFO or something of that nature in the executive suite within the organization. Here specifically, what they try to do is survey at least 300 members of the CFMA general member group. So through the survey, which they again looking at it from looking 300 plus members with the role of CFO or higher, they've looked at this. They built this what's called this confidence survey or confidence rating, and the quarterly rating, as you can see to your left there, for June 2013 is about 128, which really at the end of the day, it's down a little bit from where it was at the end of the first quarter, which is 129. But as you can see, the trend over from March 2011 through June 2013 shows pretty much that trend of confidence with a lot of these executive suite leaders feels that the industry is definitely moving in the right direction. So if you look at the index from a year ago, the index is up 3.2% from a year ago. And overall, the results are consistent with expectations for continued gradual construction industry recovery, as we talked about earlier. The second indice we'll look at is the Architectural Billing Index. This is done by the American Institute of Architects. And this is a really good index to look at because what this index will look at is it's quite obviously we know that in the construction field, everything starts with the design and the architectural phase. So this index is a good quality index to look at because it will tell us what type of activities in the pipeline. So the ABI index, it's an economic indicator that reflects approximate 9 to 12 month lag time between architectural billings and the construction spending. And the way they rate this index is that anything with a rating of more than 50 shows that the industry is growing or in a growth mode, because it would show that the billings are up and the billings are showing that there is going to be future construction activity. Anything with a rating less than 50, they show that as the industry being in recession or decline. So overall, again, this is a really good indice for us to really get a good understanding of where's the market going to be in the next 12, even 18 months in regards to the actual construction phase of projects. So if you look at the graph on the left here, that will show you where the Architectural Billing Index has been specifically over the last 5 years. As we went into the early parts of the recession, which are in that shaded blue line that is farthest to your right on that graph, you will see that the architectural billings were way down during the height or the beginning of this recession. But architectural billings have continued to increase and increase and increase to where it has spiked to its highest level here recently in May of 2013. So with this shows again that the industry, it continues to be in a growth mode. That the June ABI score was 51.6, which is down a little bit from May of 52.9. But overall, again, any score that's above 50 shows that the industry is in growth and that it shows that that we have expansion in the industry. One thing to look at is more specifically is that the new projects inquiry index was up to 62.6%, which is up sharply from its reading the previous month of 59.1. Again, a new project inquiry index means that they're coming to the architects, they're coming to the designers to inquire about how much time it will take to put a project together for planning purposes, to get it in front of whatever government entities need to review these plans before they can be final approved. So seeing that sharp of an increase, it really provides a lot of hope into what's going to happen into the future. And if you look at it by sector breakdown, the commercial and industrial sector has a billing index of 54.7. Again, pretty robust and pretty strong billings there. Multifamily residential, which is pretty consistent with what we've seen in the housing market, is at 54. In mixed practice, 52.4, and institutional, which is 51.8. So you can see all the major indices for the different sector breakdowns are all above 50, which again are showing expansion in the market. The next indicator we're going to look at is the FMI Construction Outlook Report. And the FMI Construction Outlook Report developed by FMI is a report that is done by one of the largest providers of management consulting and investment banking services to the engineering and construction industry. So FMI has a lot of experience in the construction market. And what the report details is construction put in place in 3 residential building, 11 non-residential building, and 5 non-building structure categories. So as you look at this slide, unfortunately for those in attendance, I was unable to find a nice little graphic to put on this slide. So this is all going to be just a lot of writing on the slide. But anyways, let's get to the bottom line here. And that is what FMI is seeing is that a construction put in place predictions, it shrunk a little bit in Q2 of 2013 to 913 billion from 918 billion. From their prediction for Q1 of 2013. The good news, though, however, is that if you looked at this overall, construction put in place year over year, it's up 7% from 2012, which is excellent growth in the market. Finally, FMI does expect growth to return to 8% growth in 2014, with annual construction put in place reaching 989 billion. And they feel strongly, which I don't have this on the slide, that 2015 that number could reach $1 trillion of construction put in place. That they feel that there's enough business out there right now that they're seeing in the marketplace that could push this to $1 trillion, which will begin to get us back to some of the levels that we saw back in the early parts of the 2000 era. The next indice that we're going to talk about is the ENR Construction Industry Confidence Index. And what this index is it measures executive sentiment about the current market and reflects their views on where it will be in the next 3 to 6 months and overall in a 12 to 18 month period. The index is based on responses to surveys sent out to more than 3,000 U.S. firms on ENR's list of the leading contractors, subcontractors, and design firms. And the last time that this index was updated in middle of June through the period of May 30th. Now, this index is a little bit similar to the index that the confidence index that we looked at earlier, where they sent out surveys, the CFO roles. However, this is not talking to as much CFOs of big construction companies as much as they're talking to not only contractors and subcontractors, but engineers, design firms, and architects as well. So when you look at it, they're sending it out to a way, way, way larger population, which is over 3,000 different members of their organization to get their feed and feedback as to where this industry is going. So the ENR Construction Industry Confidence Index is at 69 right now through the second quarter of 2013, and this 69 is a number that increased 4 points from the last time this survey was done. Again, this is another survey that's showing a continual increase in confidence in the industry, that both not only construction design firms but the actual contractors and subcontractors are seeing and feel that this industry is definitely clearly moving in the right direction. Virtually all the markets and sectors that they measured in this confidence index all showed growth or were in a growth mode. And finally, for the first time, all the market sectors had a CIC rating over 50, indicating expected market growth over the next 18 months. Once again, this is a survey that's really showing that the confidence from those in leadership at a lot of these organizations is there, that they feel like this market's moving in the right direction, which will hopefully lead to expansion in the job market as well, and increased jobs along with the projects that are out there. The final index I want to talk about is the Associated Builders and Contractors, or the ABC Construction Backlog Indicator. This is one of the indicators I like to look at the most, because this really is going to tell us exactly how much work is in the pipeline and what that work means in dollar value to the industry. So the CBI is a forward-looking national economic indicator that reflects the amount of work that will be performed by commercial and industrial contractors in the months ahead. The focus is on U.S. commercial and institutional, industrial, and infrastructure construction industries. And the CBI is measured in months and reflects the amount of commercial and industrial construction work under contract but not yet completed. Yep. So when we look at this, if you look at the graph on the left-hand side there, this is a graph of the United States, and it shows you by region what is happening within these regions in regards to the construction backlog. It's telling us how much of an increase we've seen year over year or quarter over quarter in the backlog, and also what to expect in total months of backlog. If you could, as you look at it, the three the West, the South, and the North are all showing increases in construction backlog and in total months of backlog. The Midwest states is showing a little bit of decline. The only reason why the Midwest states are showing a little bit of decline is because during the recession period, they were the states that were the leading states in regards to construction growth. A lot of that construction growth was found in the states of Minnesota, North and South Dakota, because that's where a lot of the energy production was occurring, and that's where a lot of jobs were. And still are at the current time. However, now you start to see the other regions of the nation starting to catch up to them, as you see growth in the South. You see a lot of growth in the North, and that growth in the North relates a lot to energy as well. As you look at the Marcellus Shale, and you see a lot of growth in the West. So overall, though, when you look at this, the CBI did decline a little bit, 1.1% during the first quarter of 2013, and now stands at 7.9 months. But if you again look at this from a year-over-year perspective, it's actually increased 7% compared to a year ago. So again, showing strong, modest growth in the market across the board. The one industry, again, that continues to lead the way is infrastructure. It continues to have the lengthiest construction backlog. And again, the infrastructure being roads, bridges, piping, any type of underground piping. And again, that would go a lot and related to energy, a lot of the energy sectors. But overall, when you look at the construction backlog indicator, all signs are positive going into the future that the construction backlog will continue to increase, and that we'll continue to develop more jobs here in the construction market. So that's the end of the economic update. I'm going to turn this over to Lisa White, who's a senior tax manager in the firm, and she's going to talk a little bit about construction tax, a little construction tax update, and what to expect as we go into the end of the year of 2013.
Thanks, Dave. As Dave mentioned, my name is Lisa White. I'm a senior manager with the tax department and with McKonly Asbury, and I'm going to be providing just a general overview of some of the tax provisions that are in place for 2013 and looking forward that have either a direct or indirect impact on the real estate and construction industries. The first thing we want to cover is the American Taxpayer Relief Act of 2012. Now, this was the answer to the fiscal cliff that we all remember at the end of 2012, and this was passed in the beginning of 2013. And a lot of the provisions in it were made either extensions of provisions that were going to be expiring in 2012 or extensions made retroactively to things that had actually expired in 2011. Another aspect that it did was actually to make permanent certain aspects that were expected to expire also. And one of those are the ordinary income rates, and these are the tax brackets from the Bush tax cut. And as you can see, the brackets were made permanent, the 10% through the 35% brackets that we've been used to. Another thing that it did was to add a new bracket, and this is the 39.6% bracket, and this is going to be applied in the beginning of 2013. And again, you can see the thresholds there. If your taxable income is in the $450,000 range for married filing jointly, you will be subject to the 39.6% rate. Another provision of the Act was to modify and to extend portions of the capital gain and qualified dividend rates. What we've had in the past have been that the two lowest tax brackets, the 10% and the 15%, would pay 0% tax. Everybody else would pay 15%. The two lowest tax brackets are going to remain at 0%. However, the 15% is actually going to be capped at the 35% bracket. Anything above that, or in other words, those in the highest bracket, the 39.6%, will have to pay 20%. But it's important to note that this does not include the 3.8% Medicare surtax. So when you're looking at the rate that you might pay if you're in that highest bracket, you're actually looking at a 23.8% rate. And also for fixed assets and depreciation, what the Act did was to extend the 50% bonus depreciation. And bonus depreciation, for those of you not aware, it's a ruling or a regulation that allows you to write off a portion of the basis of an asset that's placed into service. And you can write that off in the year it's placed in service. Then the remaining basis is then depreciated over the remaining life of the asset. What is really good about bonus depreciation, especially for contractors or large contractors on percentage of completion, that the bonus depreciation does not necessarily have to be included in your percent complete. As you can see below, they've actually included an exclusion in 2013 that matches the exclusion provided in 2010 that says that the bonus depreciation expense doesn't have to be included in your percent complete calculation. So for 11 and 12, the years that it's included, it actually works out where you end up in a net expense, that the expense isn't offset by the increased revenue that you have to recognize. But for 10 and 13, you can actually include regular, quote unquote, regular makers depreciation in your percent complete calculation. Also included was to continue the $500,000 deduction for 179 with the phase-out limit of $2 million. And from what I've read, there's actually a push to make this a permanent amount, that the $500,000 and $2 million the figures would actually remain permanent. This is bipartisan support, so it would be interesting, or it will be interesting to see what happens coming up in the next years. Another piece of the Act that was a bit surprising was the extension of the 15-year straight-line depreciation for qualified leasehold improvements. I don't think that this was expected to be extended, but it was, which is a nice benefit. Now, for contractors, given the option of 179 or bonus, I always tend to push for bonus again because of the exclusion from bonus in your percent complete calculation. If you're using 179, just keep in mind that that additional expense will have to be included in the percent complete calculation. Another part of the Act, as mentioned before, is that part of the Act actually retroactively extended some items, and this would apply here for the credits. The Act retroactively reinstated, I guess I should say, the certain credits and then extended them through 2013. This first one here, the New Markets credit, is actually one of those. And what the New Markets credit, it's a program that was developed by Congress in 2000 to try to spur development in low-income communities. And this is funded by a department of the U.S. Treasury. It comes through, there's certain funds that are set aside. Then you have community development entities. These are specialized entities that actually apply for allocation from the fund. Then in turn, the CDEs then sell those funds out as credits to external investors. The external investors get, as you can see, the 39% credit. And then the CDE then in turn lends out those funds that they receive from the outside investors as low interest loans to developers that want to come in and do low income or do development in low income communities. I'm including here also two links. The first is a link to a listing of certified CDEs and as of August of 2012. And then the second link is to the actual CDFI fund. This is the funding for the credits, the $3.5 billion. And this will provide you information on the credits. It provides you information on some of the other items that they provide. And one of the things that they do have, which is very nice, is a map that allows for geocoding of addresses. So you can see if the areas that you're interested in or planning on going into, if they actually qualify for this. Another credit that actually expired in 2011 that was extended through 2012 retroactively and then also extended through 2013 is the R&D credit. And this is research development. It's 20% of the credit based on wages and supplies that qualify for research expenses. And this was established as an anti-outsourcing tool because the credit is based on wages. I will say with this is becoming far more popular. We're seeing this a lot more. Just as a measure of safety, we would recommend that you make sure that you have a study done to support any of the credit amounts that you're showing. Given the increased popularity, it's reasonable to assume that the service will be scrutinizing the amounts that are being included or the amounts that are being taken more. Another credit, the rehab investment credit, and this wasn't one that expired, but I wanted to include it because, again, this is something that we see fairly often. The rehab investment credit, if it's not a historical structure, then the credit is essentially just 10% of the basis of it. There's no certification involved. If it is historical structure, then you do have to have certification from the National Park Service in order to get the credit. And here, the credit's going to be 20% of whatever you paid into it, whatever the rehab expenses were. There's measurement dates that you have to fall within, and there's certain amounts that you have to fall within, but the measurements are reasonable. I'll say that. The one caveat with this is that the credit amount, the 20% of the basis, has to be removed from the basis of the building. And so the remainder of the building will then be depreciated over the 27.5 or 39 year, depending on what it is. But just keep in mind that 100% of that credit would have to be removed from the basis. And then the last piece, the low-income housing credit, again, this is one that there's a credit application. This is funded by the IRS. The IRS allocates funds to state agencies, and then developers can make application for awarding of the credits. And again, you're looking at a 9% credit rate on the basis, but this is going to be recognized over a 10-year period, so essentially it's 90% of the original investment. The other piece are the energy credits, and again, these credits did not expire at the end of 2012, but I wanted to include them because we still see these fairly often. Also, just keep in mind for these, they do expire. Their expiration date is actually not expected until 2016, unless there's more extensions before then. But the energy credits, as you can see, it's 10% on certain property, geothermal, combined heat and power, and I believe it's small wind property, and then 30% for solar and microturbine. But the good thing with the energy credits is that only half of the credit amount has to be removed from basis. So when you're doing your analysis, it's say that you have taken a building and have done a lot of rehab work, and the building would qualify for historical structure, and part of the rehab includes energy credits. One of the things that you may want to do is an analysis to see which would offer you the better credit and basis scenario, because the historical credit, even though you have to remove the basis at 100% of the credit, still a 20% credit. The remaining cost or the remaining basis is going to be recovered over a longer period. Again, the shortest amount of time is the 27.5 year. For the energy credits, these are going to be treated as what's called 1245 property, which is essentially less than, I believe it's 20 years. So you're looking at 5-year property, 7-year property, that type of thing. So in addition to taking the 10% or 30% credit, only having to reduce your basis by half of the credit amount, the asset itself actually would qualify for bonus depreciation in addition to the credit amount. So again, just the whole scenario should be addressed. It's not black or white, which are the better credits to pursue. And then also the work opportunity credit was extended through 2013. Again, this is one of those areas where they're targeting certain things. In this case, it's targeting certain individuals and offering credits based on wages up to, as you can see, anywhere from $6,000 to $24,000 per employee. Some other items that I just wanted to touch on shortly. Not all of these are from the Act, but they're important to keep in mind. The first is the shortened built-in gains period. And essentially what built-in gains is, if you were a C corporation before you became an S corporation, the assets that you held when you were a C corporation, if you sell those within a certain time frame, that gain on those asset sales would be subject to the 35% rate. In other words, treated as a C corporation. So the period used to be a 10-year holding period. It was reduced to 7 years and then to 5 years. They have shortened, or they have extended the 5-year period for another year, which is really nice. And then the last piece on here is the repair versus capitalization. As far as new regulations or any regulations that are far-reaching, this would be the winner. I mean, this is the one that will probably affect most, if not all, businesses, because it completely revamps how we think about repair versus capitalization of asset and costs. Just keep in mind, right now, the new regulations are expected to be required in 2014. You can implement them now and use them now if you want, but we don't have final regulations at this point. They were supposed to issue final regs in July. Of course, that hasn't happened yet. So it'll be interesting to see what happens. The specific areas that we're expecting clarification on are going to be the de minimis amounts and then also the write-off, because as it's written now, it's kind of a catch-22. If you do one, then the other will apply, and it ends up nullifying itself. So it'll be interesting to see what they end up coming out with. And just keep in mind that when the new regulations come out, it's expected that there will be change in accounting methods that will have to be filed to be able to implement this. So the last piece that I have is the Affordable Care Act, and as everybody knows, this is coming. This is on the doorstep. We're looking at the new taxes that are going to be coming into play. And again, this is going to be on the individuals' estates and trusts where they apply. They don't apply directly to corporations, but when you issue out dividends to your shareholders, that will be where the additional tax will apply. And here you have to look at the thresholds. The AGI, and this is your adjusted gross income. If it's greater than $250,000 for married filing a joint, $200,000 for all others, you're going to be subject to these taxes. And keep in mind also the taxes are distinct and separate, which means that you could be subject to both taxes. But the income that's driving those taxes are different. They're not the same income. So the last piece that I have, again, going into this a little bit more, is looking at the Medicare surtax, and this is the 3.8% on the net investment income tax. The form that will be used, the draft form just was issued just last week. This is Form 8960, and what this will be is you're looking at your net investment income, the interest, dividends, annuities, royalties, rents, capital gains, all of those, unless they're derived in the ordinary course of business. And this is an important caveat because when you're looking at this, if you can qualify yourself as a professional real estate or a real estate professional, then you're not subject to the 3.8% income tax for those rental income. And it's an important designation to meet. There are certain qualifications that you have to meet in order to get that designation. But it would be worthwhile to do an analysis and just see if it's something that you can claim. The other piece is the 0.9% Medicare tax. And again, this is going to be on wages, so it's different from the investment income tax. And this is going to be on wages in excess of $200,000. And keep in mind that employers have to withhold if you have wages in excess of $200,000, but they're not going to be looking for and they're not going to be asking for your filing status. So if you and your spouse end up with income that's over the threshold for the amounts, yours would only have the 0.9% withholding if that's the case. If say that his or her your spouse's wages don't exceed $200,000, then you may be underpaid for that 0.9% Medicare tax. And keep in mind too that these amounts will come into play when looking at taxes and underpayment penalties. So if you think that you may be subject to these taxes, just keep in mind that you may want to do an analysis now, sooner rather than later, to make sure that you have enough taxes paid in by the end of the year. And that is the end of my update for the tax provisions or the tax impact that are happening for the real estate and construction industries. I'm going to turn it over now to Mike Hoffner so that he can provide the great information that he has in regards to audit and accounting technical update.
Thanks, Lisa. And without any pause, we'll just jump right into a discussion on the audit and accounting update. There's a lot of information that we could cover today. And in the interest of time and keeping it relevant, I've really narrowed the next number of slides down to things that I hope and think are probably the most relevant to those on this call. So just want to be upfront and say we do not intend this to be a comprehensive coverage of all the recent updates and the coming updates, but want to spend a few minutes talking about some of the relevant items. So as we get started on the accounting standards updates, really wanted to focus in on three specific ones that have come out in the last year and a half or so. There have been quite a few ASUs in 2012 and 2013, many of which are not at all applicable to most of you on this call, some of which might be applicable, but I chose to leave out because they're not broadly applicable. And then we'll focus in on just these three. The first being an accounting standards update on comprehensive income, which very simply requires additional disclosure and reporting of amounts that have been reclassified out of other comprehensive income. Many of you have on your financial statements OCI, other comprehensive income, which is a measure, a way to capture things such as many of you might have effective interest rate swaps, derivative instruments. You may have some foreign exchange matters. So the disclosure requirements have been enhanced, have been clarified, and some of the way that you need to present an account for things that are reclassified out of accumulated other comprehensive income have been better specified and clarified. So be aware of that. That is effective for fiscal years beginning after December 2013, and and so therefore it's going into next year, all quarterly and annual periods next year for most of you on this call. The second one I wanted to briefly talk about, and hopefully, and Lord willing, is not effective to any of your businesses, is relative to the liquidation basis of financial statements. When you have a liquidation basis, it essentially means the organization's winding down. We see it most frequently with defined benefit pension plans that have been frozen and are being terminated as a 401k option has been created, or a different type of benefit plan for a client has been created. But occasionally we do see liquidation basis, and unfortunately, as over the last 6 or 7 years, unfortunately, it's been a lot more common that entities have had struggles through economic times. This has been a hard-hit industry. And so there is some clarity on when and how to apply the liquidation basis of accounting and how to disclose some of the things that are in those financial statements if an organization or a pension plan is winding towards completion. And again, this one is effective for fiscal periods also beginning after 12/15/2013. And so it would be a next year item, although for this one, earlier adoption is permitted. And the third of the accounting standards updates that I did want to touch on today, and this is one of the recent standards that has come out that I would say is beneficial and helpful, and it is relative to how you do an assessment of the valuation of goodwill and other intangibles on your balance sheet. Many of you remember back in the good old days, goodwill and intangible assets were just amortized over a 15-year period. Very simple, straightforward, no judgment involved. Every now and then you had to look at it. And then a number of years ago, the FASB came out and said, nope, no more amortization for book purposes. Now you have to do an annual assessment of the valuation of your goodwill and intangibles. And that was a somewhat rigorous and complicated financial calculation to determine what the fair value of those items were. We recently had the ability to do an initial qualitative analysis of goodwill, and this accounting standards update allows us to do a very similar approach for intangible assets. So if there are indefinite-lived intangible assets that were acquired in a business combination, there's quite a few of those out there. There may be trade names, there may be customer lists, things like that, which historically have an indefinite life and would have required you to do a financial and a fiscal analysis of the value. We are now permitted to do an initial qualitative assessment, much like with goodwill, and say, do I or don't I need to now go and do a fair value calculation? So this is one of those, as I said, that the FASB has actually stepped up and done something that a common sense approach has always said is the right thing to do, and it should make some of your lives a little bit easier as you go into your financial reporting for this year end. And again, just to highlight, there are many other accounting standards updates that were issued in the last 2 years. Do not intend to go through all of those today, but certainly don't consider these three to be the only ones that you should be aware of. Now we're going to move away from the issued standards and start to talk a little bit about the future standards, the things that are on the horizon that you've all been hearing about. And I'll say the same thing I said with the accounting standards updates. This is not intended to be a comprehensive look at what's coming. If you go to the FASB's website, you will see a whole host of projects they're working on, a significant list of items that you may see come to fruition over the next 18 to 24 months. But we're really going to just talk about two items that, quite frankly, we've been talking about now since about 2009. Exposure drafts came out in 2010 for leasing and for revenue. And since then, we've been talking and trying to understand where these were going to go. And here we sit in the middle towards the end of 2013. And we finally have some real good clarity on both of those projects. And so I'm going to talk for a few minutes on each of those. First, we're going to speak on leasing. We're going to talk just a little bit about what the status of that project is, where they are on things, and if you had seen any of the recent releases. The FASB actually revised the accounting standard update, the proposal, in May of this year, and basically went back and rewrote the 2010 exposure draft, which many of us have talked about for years, to try and fold in many of the comments and concerns that were heard. There were a lot of changes to the original exposure draft. Many of them affected the lessor side of things. There were a lot of concerns in the initial exposure draft on the lessor, but a lot of them also were tweaking the way that things were calculated for the lessee. If you'll remember back in the 2010 version, the first exposure draft, there were a lot of things that just seemed a little bit silly to most of us, again, from a common person's approach or a common sense approach. If you look at the second bullet point there, relative to the consideration of extension options. In the original exposure draft, you were supposed to calculate and factor exactly what you thought would happen with all options to extend a lease. So when you determined if you had a 10-year life with 2 5-year renewal terms, when calculating this item to go on your balance sheet for the right to use that asset, you had to project out the likelihood you might renew those leases, and you might end up saying, well, it's 14 and a half years is my expected life, or 12 and a half years, or I have 2 different methods I might calculate. Just got a little bit silly. So they did simplify that, simplified some of the consideration necessary for variable lease payments, and went into some specifics to help people think through the idea of when does a service contract or a production contract actually contain an embedded lease and require separate accounting for that. So as they've fixed some of those items, there's some things that we still need to think about, things that are not different from what we've talked about for the last 3 years. First and foremost, you will still be putting on an asset and a liability for virtually every lease. So there has been really no significant change in terms of this idea of a capital versus operating lease going away. All leases have economic substance, and all leases will now result in an asset on your books relative to the right to use that lease and a liability to pay for that. The one exception they've made, which was not in the original exposure draft, is that they have identified what's called a short-term lease, which is a lease with a maximum possible term of 12 months or less, and that includes any option to renew or extend. And if that term of 12 months or less applies to a lease, then you can still continue to treat that much like the old operating leases were treated. And when you assess that 12 months or less idea, you do have to include rent holidays or rent-free periods. So you can't just sit back and say, well, I signed a 15-month lease with a 4-month rent-free period, and so therefore it's under 12 months. You do have to factor that in. There's a little bit more clarity in the new exposure draft about how to calculate your initial lease liability and the asset value that you're going to use. Not significantly different from what was there in the previous draft. Finally, among many other things that are in this proposed exposure draft is some further discussion on when the lessor removes the asset from their balance sheet or when they keep it on the balance sheet or how they make that decision. And this gets to the idea of whether the lessee is expected to consume more than an insignificant portion of the economic benefits of the underlying asset. So there's a decision tree that needs to be made from the lessor side that says, do I retain this asset on my balance sheet, or do I remove this asset from my balance sheet, almost like the old sales type leases where it's no longer on the balance sheet because I've essentially sold the asset even though it's under a lease. That certainly is not intended to be a comprehensive look at what the new exposure draft says, and please understand that there's going to be a lot of nuances in that when the final document comes out will need to be understood, will need to be addressed, and there's a lot of moving parts that will have to be factored as you try and determine the impact on your balance sheet, and we'll certainly talk more about that as the final document does come out. The final standard's expected in 2014. I think I said 3 years ago that it was expected in 2012, and 2 years ago expected in 2013, and now it's expected in 2014. But I do believe this time they're actually at the final spot, and it should come out. And one thing to keep in mind, based on what the proposal says, is that all that guidance will need to be applied to all leases that exist as of the beginning of the earliest comparative period presented. So for companies that present 3 years of income statements, they will need to present 3 years worth of financial statements as if this standard had been in effect. So for that reason, when the final standard comes out in 2014, there's an expectation that there's at least a 3-year run out until it becomes effective, and that will probably, and don't quote me on this, but most likely be an extra year for non-public companies to make sure everything gets lined up and ready to go. Moving on from leases, we're going to touch for a little bit on revenue recognition, an item that over the last few years has been very near and dear to the construction industry's hearts and minds, with a concern when the first exposure draft came out back a few years ago that we may lose the opportunity to do percentage of completion accounting. And certainly that would have been devastating to the industry and really thrown things upside down in how users of the financial statements view the success and profitability of a company. So after a lot of redeliberation in the last 6 to 8 months, a lot of final decisions were affirmed, and we do expect to have a final standard in Q3 of 2013. And I'll say again, don't hold me to that, but that's what we're reading on the FASB website. That's the expectation. So we should be able to spend some time in late 2013 really diving into the final standard and starting to talk about how exactly it's going to impact the way you account for your construction contracts. Most of the changes that were made from the recent exposure draft to the one that just came out last year are favorable to the construction industry. And I say favorable because they move things back towards what is more similar to the way we used to do things. And frankly, I think that's a good thing. And that's because of a lot of input by industry groups. CFMA and others has been very active with the FASB in trying to ensure that any unintentional consequence on the construction industry was brought up through the exposure process, was addressed and reworded in a way that still accomplished the FASB's objectives, but did not throw a wrench in the gears for our industry. So as the FASB has deliberated, there's a few things that they've changed that we need to think about. Things that as the final standard comes out, I won't go into excruciating detail right now, but when the final standard comes out, you can expect on Contractor Centerpoint that we will give you more information and more detail on some of these items. Some discussion on bad debt and how impairments in customer receivables needs to be clearly presented and stated as an expense item, which wasn't always the case, depending on how you looked at things. There is some clarity granted now on uninstalled materials and how to determine when you're doing a cost-to-cost calculation for your revenue recognition, how to determine whether uninstalled materials that are parked on the job site should be factored, shouldn't be factored, and how that impacts things. And then there's also a change from the original exposure draft about variable considerations, so your claims and such. And this really, most of you will read this and say, well, that's how it is now. We can't recognize it until it's a certainty when you get into a claim. But the original exposure draft actually had a little bit more of a process involved in trying to determine whether you had to record the prospective claim revenue as part of your revenue calculation. So this change, while it is a key impact or a key change impacting the industry, is really not a significant change from the way we used to do things. So there's a lot more, obviously, to it that we'll need to pay attention to. But as we go through a few other things here, loss provisions, I think the original exposure draft had some complexities relative to potential lost jobs, and the existing guidance based on how things are now worded will be continued to be followed. So when you know that there's a loss in a job, that's when you deal with it and go forward from there. Effective date for the new standard when it comes out is expected to be for years beginning on or after January 1st, 2018 for non-public entities. So lots of time to get everything squared away. As the final standard comes out, we will have some further discussion relative to how to figure out the transition process. The transition can be done one of two ways. One is retrospective, so you go back and restate each of the presented years to show the revenue and all the balance sheet impact as if this standard had always been affected. Or they're also offering, which I think is going to be beneficial to most of the mid-market and smaller contractors, is a practical expedient where essentially you determine what those contracts would have been on the beginning of the first year this is effective. And instead of restating all the prior years, you just do a cumulative catch-up through opening retained earnings and fully disclose, of course, in the financial statements how you came up with that number. So I suspect as we get the final document and we start the implementation process with many of you, we'll work through what the best answer for you is, and we'll work out how to get the right journal entries to get to the right presentation over the next few years. This next slide just is a recap of the steps in the new proposed revenue recognition model. Nothing on there is dramatically different from what we've been seeing for the last few years, so I won't take time to go through it, but I did want to put it in the presentation just as a highlight for things that you'll need to consider. So we're going to finish up now with a little bit of discussion on private company accounting and where that stands. And it'll be a fairly brief discussion because there's still a lot of uncertainty with what the ultimate direction will be. What we do know is we are moving very quickly towards a direction of splitting out accounting standards for private companies and creating a little bit more of a simplicity in certain areas for private companies that really has never been something that was critical or important to most of you. So just from a status update, earlier this year, the AICPA issued a financial reporting framework for small and medium-sized entities. Essentially, this is an other comprehensive basis of accounting, much like the income tax basis or the modified cash basis. This would be a basis of accounting that is clearly defined and would be more broadly applicable to those organizations that aren't required to use U.S. GAAP. So it is not an alternative to GAAP if you're required to do GAAP financial statements. What it is a more clearly identified, if you were formerly allowed to do for your bank, say, a modified cash basis, this would be a different basis of accounting that is more consistently applied and should be a little bit clearer. On the same day, actually, as the AICPA issued that framework, the FASB issued 3 exposure drafts from the Private Company Council, really focusing on things that are not as applicable to non-publics and ways to create alternatives to current GAAP for those smaller organizations or the non-public organizations. The 3 topics they focused on: basic interest rate swaps, how to recognize and measure intangibles other than goodwill, and the subsequent measurement of goodwill. All 3 of those exposure drafts have comments due later this month, and when those comments are finalized, we'll see how quickly they move, but we may start seeing specific instances of GAAP that have been in place for a number of years, which will be simplified for non-public entities, and therefore, for pretty much everybody on this call, should be a step in the right direction towards private company GAAP. So we will see where this evolves. It's unusual to have 2 different organizations going down 2 different paths, so I'm sure they will continue to work together. But ultimately, I think we're all very encouraged here that there will be some sense of relief on the complexities of accounting for non-publics. So that's all we're going to go over today for the technical update. And with that, I appreciate your time, and we'll take questions at the end of the presentation.
Questions that we have here that have come across from the presentation. I will go first. There's a question here from one of the participants relating to the construction backlog indicator and some of the increases that we saw there. The question relates to whether the increase in the Northeast backlog indicator, if some of that is related to Hurricane Sandy construction. And my answer to that would be yes. Some of that is related to Hurricane Sandy construction, as there obviously is a significant amount of construction activity in that area. I would also say that part of that increase is probably related to our energy information that we have here in Pennsylvania relating to what's happening with Marcellus Shale and some of the activity that's happening in the northern part of the state with the Marcellus Shale, and also happening now starting to happen in the Ohio region as well. So I think that's part of the reason why you would see some of the increase in the construction backlog indicator in the Northeast.
Thank you. I think I'll take the next question. There was a question as to if there have been any updates on with the recent budget that passed here in Pennsylvania. And I will just share with you the budget was passed on time at the end of June. And I'll just share with you a couple of the items that passed that may have significant value. One is the capital stock tax, again, that was expected to be phased out. And that phase out is no longer going to happen, or the phase out has been extended. It was supposed to be gone in 2014, so now it's been extended for another 3 years, I believe. And then the other piece that I'll touch on is just the corporate tax rate that was supposed to be affected. Nothing has moved on that. But if there are any specific questions as to what pieces in the budget are still there, what pieces in the budget might apply, please feel free to email the questions directly to me or anybody here on the panel.
We'd like to thank you once again for joining us for this presentation presented by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thank you again and have a great day.